Hi, this is Jojo Salas. Welcome to The Glimpse. For this edition, I will be providing you with the latest updates on the Philippine real estate market. Before that, I will present selected indicators that will show the performance of the economy, as well as their impact on the real estate market. The gross domestic product grew by 6.5% during the first half of the year. This is within NEDA's projected growth of between 6.5 to 7.5%. While this is slightly lower than the 6.8% growth in 2016, Philippines got the second spot for the highest growth rates among its peers in Asia. China is on top with 6.8% growth, while Vietnam is third with 6.4% growth. In terms of net foreign direct investments, BSP figures show that the total investments from January to July this year reached $3.9 billion. This is 16.5% lower for the same period last year. At any rate, this is still at pace to breach the $7 billion mark. That was done for the first time last year. It should be noted that the figures do not include investments by the BPO companies. According to BSP, the average bank lending rate from October 9 to 13 of this year slightly decreased to 3.47% as compared to 3.86% towards the end of 2016. This dip is very attractive for borrowers and investors. In terms of overseas Filipino remittances, Pinnacle monitors its continued growth. Total remittances from January to August of this year reached $18.6 billion. This is an increase of 5.4% year-on-year. Dollar remittances are on track to eclipse the $26 billion performance last year and perhaps reach the $27 billion mark this year. For inflation, latest PSA figure shows that the inflation rate increased to 3.4% as compared to the annual average of 1.8% in 2016. This increase is still within BSP's target inflation of between 2% and 4%. More importantly, the increase proves that the government, businesses, and consumers are now spending more, and this would in turn push further growth. On the tourism front, DOT figures show that the total international arrivals for the first half of 2017 reached 3.36 million from 2.98 million for the same period last year. There is a significant increase of 12.73% between the two periods, despite the negative publicity of the Marawi conflict. At this rate, the target of 6 million arrivals by end of the year appears imminent. Lastly, unemployment rate released by PSA is pegged at 5.6% as of July 2017, which is slightly better to the 5.8% unemployment rate as of April of this year. Again, this is a strong testament that the yearly graduates are being absorbed by the labor market. The nominal average unemployment rate hovered at 6% in the past 5 years. These indicators generally point that the Philippines has sustained its robust growth. The upbeat macroeconomic indicators bode well for the real estate market in general. Most, if not all, real estate developers have been cashing in from the robust Philippine economy and booming real estate market in the past years. Due to the massive construction in the past years, however, some sectors like the mid-market residential condominium market in Metro Manila are becoming very competitive due to the fact that all players want to have a market share in this segment. Margins and profits are still there to be made, but have been compressing due to sheer competition. On a separate front, the office market is slightly softening due to the protectionist Donald Trump administration, thereby creating a little bit of uncertainty. Pinnacle Research is in the view that the property market will definitely expand and grow, especially for the established companies. But it is not for the feeble heart and underprepared. As earlier reported, the Ayala Land Group will launch approximately 100 billion peso worth of projects this year. This is an increase of 64% from last year. The net income of Ayala Corporation increased by 9% in the first half of the year to 15.1 billion pesos, primarily driven by the solid contributions of its real estate and power generation businesses. Meanwhile, SM Group has been selling 15,000 to 20,000 units a year, reaching 31 projects with more than 50,000 units delivered to residents. Based on reports, SM Investments Corporation has increased its income for the first half of the year by 9% to 16.6 billion pesos. The Mega World Group, which is reported to be the biggest lessor of office spaces and urban township developer, recently launched its 30 billion peso township in San Fernando, Pampanga, covering a total land area of 35.6 hectares. In addition, MegaWorld continues to ramp up its commercial portfolio with the opening of the 2 billion peso Southwoods Mall this year. Robinsons Land Group has been growing its recurring income from malls, offices, and hotels. The group is now targeting to open its 271-room Dusitani Mactan Cebu Resort by 2019. This is a luxury resort property. This is in addition to its Go Hotels, new malls in Cebu City, Tagum in Davao, General Trias in Cavite, and Haro in Iloilo, and the mixed-use development in Naga, Bicol. The top developers very well know their strengths and core competencies and strive to maintain them. At the same time, they always find new ways on how to sustain their growths. We are expecting the real estate market to be more competitive. But rest assured, all of the sectors rest on real demand, albeit somewhat softening. With the softening demand, the going would get tough, but the tough gets going. Here are the snapshots of the Philippine real estate sectors. Office take-up continues to be strong, despite the slight softening of demand from BPOs. Because of this, traditional companies and government agencies may start filling in the demand gap. Nevertheless, the office sector is sustained by very high occupancy levels and stable rents. For the residential sector, the housing backlog persists. Demand for the residential products has been steady, while the middle market condominium remains very competitive. Metro Manila fringe areas are now being explored to serve the demand for the affordable and socialized segments. In the retail sector, small retailers are still queuing to enter in choice retail malls to get a share of the demand from consumers and shoppers, especially during the Burr months. Further expansion is still targeted by big players. They are now testing various retail platforms, especially the convenience store setup. On the hotel and gaming front, international and local brands are being introduced to attract the increasing tourist arrivals. The redevelopment of Intercontinental Manila and Mandarin Hotel created opportunities for new five-star hotels. For the industrial sector, sustained demand alongside limited quality stock as well as stable rent continues to be the main feature of the market. Public and private sources have been unanimous in claiming that the growth of the various real estate sectors is backed by strong demand. The real estate developers have been aggressively serving the demand of the buyers and renters in the past years, making the competition tougher. As discussed, the big players have been innovating and blending their product offerings to maximize their coverage and optimize their margins. Pinnacle Research recommends to continue building supply for the demand that one has meticulously identified. Like most developing markets, there are gaps that may be filled in by the most diligent real estate players. You can read the full report by clicking the link you see on the screen.